Bond market and yield curve analysis. Bond market overview. The bond market is a crucial component of the global financial system. It's where various entities, including governments, corporations, and municipalities, raise capital by issuing bonds to investors. Bonds are debt securities that represent a loan from the bondholder to the issuer. They typically have a fixed interest rate, coupon rate, and a maturity date at which the principal amount is repaid. Journal entries and accounting treatment. Bond purchase. When a company purchases a bond, it records the initial transaction as follows. Journal entry for bond purchase: debit, bond investment, asset. Credit, cash or bank, asset. This entry reflects the use of cash to acquire the bond asset. Recording interest income. As the bondholder, the company receives periodic interest payments from the bond issuer. Interest income is recorded when received. Journal entry for interest income. Debit, cash or bank, asset. Credit, interest income, revenue. This entry reflects the receipt of cash and recognizes interest income as revenue on the income statement. Bond sale. When the company decides to sell the bond before its maturity date, it records the sale transaction. Journal entry for bond sale. Debit, cash or bank, asset. Credit, bond investment, asset. Segments of the bond market. The bond market can be divided into several segments based on the characteristics of the bonds and issuers. Government bonds. Issued by national governments to finance public spending. They are generally considered the safest bonds and serve as benchmarks for other interest rates. Corporate bonds. Issued by corporations to raise capital for various purposes, such as expansion or debt refinancing. Corporate bonds come in different credit ratings, reflecting the issuer's creditworthiness. Municipal bonds. Issued by state and local governments to fund public projects like schools, highways, and infrastructure. They often offer tax advantages to investors. Agency bonds. Issued by government-sponsored entities, GSEs, like Freddie Mac and Fannie Mae. They have implicit government backing and are used to finance specific sectors, such as housing. Types of bonds. Investment-grade bonds. Issued by corporations with strong credit ratings. They have lower default risk and typically offer lower yields. High-yield bonds, junk bonds, issued by corporations with lower credit ratings. They offer higher yields to compensate for the higher default risk. Convertible bonds can be converted into a specified number of the issuer's common shares. Investors receive periodic interest payments until conversion. Zero-coupon bonds. These bonds do not make periodic interest payments. Instead, they are sold at a deep discount to their face value and pay the full face value at maturity. Investors earn a return through capital appreciation. Callable bonds. Callable bonds give the issuer the option to redeem the bonds before maturity. This can benefit the issuer if interest rates decline but may be a disadvantage to investors. Floating rate bonds. These bonds have variable interest rates that adjust periodically based on a reference interest rate, such as the LIBOR. They are less sensitive to interest rate changes. Perpetual bonds. Also known as perpetuities, these bonds have no maturity date. They pay periodic interest indefinitely but may be callable by the issuer. Savings bonds. Issued by the U.S. government, savings bonds are designed for individual investors. They offer safety and competitive interest rates. Government-sponsored entity, GSE, bonds. Issued by entities like Freddie Mac and Fannie Mae. While they are not direct obligations of the government, they are often considered relatively safe due to implied government backing. Yield curve analysis. The yield curve is a graphical representation of interest rates for bonds with different maturities. Yield curves can have various shapes, each of which conveys important information to investors. Normal yield curve. In a healthy economic environment, longer-term bonds typically have higher yields than shorter-term bonds. This upward-sloping curve suggests that investors expect the economy to grow steadily. Inverted yield curve. When short-term interest rates are higher than long-term rates, it can signal an economic slowdown or recession. This inversion can be a precursor to economic downturns. Flat yield curve. When short-term and long-term rates are similar, it may indicate uncertainty about the economy's future direction. Investors are unsure about whether interest rates will rise or fall. Significance for investors. Understanding yield curves is essential for investors because they provide insights into the state of the economy and can influence investment decisions. Interest rate expectations. Yield curves can help investors gauge where interest rates might be headed in the future. This information is valuable for bond investors who want to maximize returns and manage interest rate risk. Risk assessment. The shape of the yield curve can indicate the overall risk appetite of investors. For example, an inverted yield curve may signal that investors are seeking the safety of longer-term bonds due to economic concerns. Portfolio diversification. Investors can use bonds with different maturities to diversify their portfolios and manage risk. For example, during a flat or inverted yield curve, longer-term bonds may provide stability and income. Economic indicator. The yield curve is often considered an economic indicator, and policymakers pay attention to it. Central banks may adjust monetary policy based on yield curve trends. In conclusion, the bond market is a vast and diverse marketplace that offers various opportunities for investors. Understanding yield curves and their implications can help investors make informed decisions about bond investments and navigate changing economic conditions. Thanks for watching.